Hey everyone, welcome back to The Explainer. Today, we're diving into a really fascinating financial event, the 700 crore rupee initial public offering of Lumino Industries. But what makes this one so compelling isn't just the sheer size of the offering, it's the story happening behind the scenes. We are getting a front row seat to a company that is actively trying to change its fundamental DNA. We're going to look at exactly how management is navigating some pretty serious financial hurdles by pivoting their entire business model. So, here is the game plan for today. We're going to break down the 700 crore IPO, look at their debt and capital situation, unpack this big strategic product pivot, solve their cash flow puzzle, and finally, we'll forecast future margins and growth. I promise to demystify all these numbers and get straight to the investment thesis, just looking at the facts totally objectively. Let's get into it. Section 1. The 700 crore IPO breakdown. Right out of the gate, we've got the pricing details. The IPO price band is fixed at 78 to 82 rupees per share. Keep this entry point in the back of your mind as we evaluate the fundamental health of the business. Now, what's really interesting is how that 700 crore is actually split up. The total IPO isn't just a massive lump sum going straight into the company's bank account. 500 crore is a primary issuance, meaning that's new money actually entering the company to fund operations and pay off obligations. The remaining 200 crore is an offer for sale, or OFS, which basically just means existing shareholders are cashing out some of their equity. So the crucial active capital we really need to track today is that 500 crore. Section 2. Debt, upgrades, and capital. Let's follow the money and see where that primary capital is heading. The allocation here is incredibly telling. Out of that 500 crore, a massive 385 crore is earmarked specifically to repay existing debt. That is the vast majority of the new capital, right there. Another 15 crore is going toward revamping their existing manufacturing facility over in Kolkata. The balance, which is around 140 crore, is slotted for general corporate purposes. The big takeaway? This IPO is overwhelmingly an exercise in cleaning up the balance sheet. And honestly, this perfectly illustrates why that cleanup is absolutely crucial. 8.5%. That's the company's current cost of borrowing on that debt. By using the primary funds to wipe out that 385 crore burden, Lumino Industries immediately removes that 8.5% financing cost. That is going to provide a direct and immediate boost to their bottom line. All right, Section 3, the strategic product pivot. Like I mentioned earlier, this is where they change their DNA. Why is Lumino carrying all that debt in the first place? And how exactly are they shifting their business model to solve it? So during recent interviews, management faced some pretty tough questions about a drastic drop in total revenue growth, falling from a robust 36% in FY25 to just about 6% in FY26. Sounds bad, right? But the metrics reveal a highly intentional strategy. While total growth slowed down, the high-value product side of the business actually grew by 15%, jumping from 1,250 crore to 1,440 crore. At the exact same time, they purposely shrank their EPC division, that's engineering, procurement, and construction, from around 800 crore down to 670 crore. You might be wondering, why purposefully shrink a major revenue stream? Well, it's because EPC work ties up your cash for years. The turnaround time takes 24 to 36 months. It's kind of like being stuck in a never-ending kitchen remodel. Actually, scratch that. At this scale, it's more like rebuilding the whole house. In stark contrast, the turnaround time for their product division is merely 3 to 4 months. To put that into perspective, Lumino currently has a 1,200 crore order book on the product side that will be completely turned around in a fraction of the time it takes to finish a single EPC construction project. And the products they are pushing? They aren't just your standard generic wires. The MDs highlighted something called an STLS conductor. That stands for high temperature, low sag conductor. This is a huge, high margin buzzword in the power segment right now. It gives Lumino a massive competitive moat, primarily because they are among only 4 or 5 manufacturers in all of India capable of handling the entire life cycle of this product. We're talking design, manufacturing, supply, installation, right down to securing the performance certificates, the whole shebang. Because of these much better margins and super fast cash turnaround, management is explicitly targeting a new, sustainable revenue mix moving forward. They are aiming for 70 to 75% of their revenue to come strictly from products and capping EPC at a maximum of 25 to 30%. They just want capital flowing quickly, rather than getting bogged down in endless construction delays. Section 4. Solving the cash flow puzzle. Because those past construction delays we just talked about, they certainly left a mark. This is a really vital question, and it was a big red flag for a lot of people. Why did trade receivables, which is basically money the company is owed by clients, practically double from 460 crore in FY24 to a staggering 900 crore in FY26? That is a massive pile of unpaid invoices just sitting on Lumino's books.
The answer points straight back to their older business model. Over the last 2 financial years, Lumino took on a lot of power sector distribution EPC jobs. Those clients are typically government-linked electricity boards, and they have been, well, incredibly slow to pay. This created severely elongated working capital cycles. Now, management noted that these jobs are totally completed at this point, and they do expect to recover a lot of these payments in the second half of this current financial year.
But to make sure this doesn't happen again, they aren't just shifting away from EPC generally. They're changing the specific type of EPC work they even accept. They are actively walking away from the problematic distribution jobs and focusing instead on extra high voltage, or EHV, substations up to 400 kV. This specific niche offers better margins and, crucially, way less risk of these massive payment delays. Let's walk through the timeline of how this cash flow crunch actually played out. Step 1, the delays caused Lumino to suffer a negative 240 crore operating cash flow in the prior year. Ouch! Step 2, they bit the bullet, deployed working capital, and fully completed those delayed power sector jobs. Step 3, as those old invoices finally start getting paid, their operating cash flow turned positive again in FY26. It suggests the worst of the cash flow crunch is likely in the rearview mirror as those old projects finally close out. Okay, Section 5, Future Margins and Growth. We've seen the pivot and we've seen the problems. Now let's look at historical performance and what management is promising for the future. Despite the recent slowdown in total revenue, management is very quick to point to this impressive number, 25 to 27%. That represents the company's compound annual growth rate over the last 10 years. Alongside this, they claim to have maintained a 10 to 11% EBITDA margin pretty consistently over that same decade, even while navigating through a 12 to 15-month blip during the COVID-19 pandemic. Looking ahead, they are actively expanding their product portfolio to protect and boost those profit margins. The company is opening an upcoming high-tension or HT cable facility in West Bengal. This new plant is going to give them the capability to manufacture 11, 33, and 66 kV cables, which further expands their high-margin product offerings. Which brings us to this quote from Managing Director David Goyle. I think it perfectly summarizes their entire strategic pivot and investment thesis. He literally said, I'm adding products in the portfolio which will give me better margins, reduced working capital cycle, and improve my cash flow. It is a clear stated intent to fundamentally shift how this business operates. So we are left to weigh the risks and rewards of this corporate transformation. Can Lumino actually pull off this aggressive pivot towards specialized high-margin products? Or will the ghosts of those massive unpaid EPC contracts continue to haunt their balance sheet? It is going to be a fascinating scenario to watch unfold for sure. Thank you so much for joining me for this explainer. Keep learning, and I'll see you all next time.